Let's talk to Ross Norman, CEO of Sharps Prixley. He joins us now live from Hong Kong. Ross Norman, a very good day to you. Well, America's fiscal cliff looms. Is the only way up for gold?
Absolutely. We saw brinkmanship back in April 2011, and that indeed drove gold to an all-time high of 1921, a figure it reached in September last year. Since then, gold's come off, and of course, are we going to see brinkmanship yet again between the two political parties in the States? And if we do indeed see that, well, we would expect gold to correspondingly rise, and we may well see a new fresh all-time high. But let's not forget, we're focusing on the fiscal cliff. But there's also the debt ceiling to consider as well. The US will be reaching its debt of $16.4 trillion early in the new year, and the likelihood is that they're going to battle again over that, with the domestic scene being fought out of America with ramifications across the world. So it remains to be seen how that's going to play out, but certainly gold looks well positioned for the story.
And how long will the quantitative easing effect last? Because no doubt that's been giving a lot of support to gold from central banks right around the world. Does it start to wane at any point, or actually is that also going to keep that momentum going strongly?
Well, absolutely. If you charted gold's price performance over the last few years and looked at the scaling of the balance sheet of the Federal Reserve, you'll see it pretty well mirrors. And the latest QE round that we've seen, what some refer to as Q infinity, we think we'll see a further expansion of that balance sheet, particularly with Obama being in power. And the corollary to that, of course, is that gold will continue to rise. How long will this go on for? Well, it's a tough one to answer for. If we thought it's for the next four or 5 years, well, gold's had a run rate of 17% on average over the last decade increases. If we see that for another 3 or 4 years, we could effectively see, through the effects of compounding, a doubling in the gold price.
Ross, what's very interesting, isn't it, when you look at the gold price and you compare the gold price to gold mining stocks. Now, in the past, they've always correlated really rather nicely, but now gold is outpacing those mining equities. Why is that?
Absolutely. Yes, well, there are a number of thoughts on that. One, of course, is that historically the institutional investors didn't have direct access to gold. They couldn't trade the gold market because it was on an exchange that they were prohibited from trading on. With the birth of the gold ETF, something which has transformed the gold market about 6 years ago, investors now have a conduit to the gold market, and to some extent gold, or direct access to gold through the ETFs, has stolen the show for miners, and indeed through the ETFs, which is a form of trading gold on a conventional stock exchange, you can also get some leverage in there on a 2-to-1 basis. So to some extent investors have gone to the ETF. The other side of the story, of course, is that the mining equity sector has seen a lack of M&A, and that's the kind of thing that you need as mines develop. And indeed there's a lot of resource nationalization, and worst of all, you've got rising costs. So to some extent the mining sector has been depressed while gold has continued to rally.
Ross, can I just ask you one final point, and that's on the price of gold, and you're saying over the next few years it could well double. What about demand destruction, though, when you get to those particularly high prices? I'm thinking of India. I think it's now is the world's biggest producer of gold, isn't it? Not producer, but jewellery maker of gold. What about that? Is that a real factor now that actually will take the shine off this metal?
Absolutely. There are factors to consider, and India unquestionably will be the biggest one. We've had a poor monsoon this year after 2 fantastic great years, and as goes the monsoon goes the harvest, and as goes the harvest goes the gold spend, and this has been a poor year. Worst of all, although gold's only up 11% in dollar terms, it's up 18% in rupee terms. The effect of the weak Indian current manufacturing in India, you alluded to it earlier in an article just a few minutes ago, that is depressing the price of the rupee. The other side to which is gold prices in Indian rupee terms are very, very high. That will depress the prices, unquestionably. And I think markets will be watching very closely to see how that plays out. This day today is the beginning of Diwali, the traditional season for buying gold in India, and the markets will be looking very closely to see how it's going. So far, local prices are edging very much higher, suggesting it's going to be a good year, despite the pretty poor first half of the year.